What is the most important thing to look for this round?
So I think the first thing is that profits have been declining. We're looking for a 7% decline in earnings per share year over year. So we're resetting the earnings estimates because of the historic change in interest rates. So I think that's going to be on the table, and that's probably going to play out in the next couple of quarters. And then the market's watching very closely on credit. We think credit costs from the first to second quarter will be up 20%, but remember, up 20% from zero. So it's still very benign. And I think the market wants to know, what about credit? And so I think those are the two biggest themes. And then investment banking, just like Kelly just said, which is it's going to be a terrible quarter for investment banking, but we think it's turning, and we actually have been recommending investment banking stocks.
Yeah, I mean, it's coming in dribs and drabs now, at least the either early tells or anecdotal reporting about maybe a turn in the first quarter or sooner. I don't know. What do you think?
So what it is there are two things to look at. One is capital markets, which is follow-on equity. There's a lot of pent-up demand, especially out of private equity, to sell shares. And so as the stock market's been holding in there and been rallying, it's almost like sector by sector you've seen the on switch turn on. So that's actually going to be a good quarter. The second thing is investment banks get paid when mergers close, not when they're announced. And so the gap between announcements and closures is widening, which means we're getting more announcements, which means we should get more revenue in the second half of the year, and that's building. So that makes us feel better.
What about some of the other stuff? Delinquencies, write-downs of real estate?
Real estate is the big issue,
yeah.
and you can get even more specific all the time. You could say it's commercial office buildings, it's the big buildings, and it's in the cities. And so our commercial real estate research group believes that there's 30% downside to valuations in those this cycle, and that we're about halfway through. But there's going to be more write-downs in commercial real estate. We think you'll see it in the Goldman quarter because they have a lot of equity investments in real estate. They'll probably be writing that down.
Well, Solomon flagged that in our last interview. Who else is exposed?
Well, you know, first of all, one of the stories is how much credit, and there's a whole nother theme, is not in the banking system. Since Dodd-Frank was passed, the banks have lost market share to non-banks. I think you're going to see a lot of it in the non-banks. But the bigger banks tend to have the bigger real estate projects. And so Wells Fargo tomorrow, they've already been talking about increasing reserves. They may have, we think, a 9% reserve against their large office building portfolio. That's actually a big number. So I think that's going to be part of the topic around this commercial real estate theme.
Do you think the industries, the lobbying groups have been vocal on capital requirements, saying it's going to hurt access to loans or increase costs for borrowers? Do you think it'd be painful for the industry?
I think the big step, if we take a step back and just don't look at it quarter by quarter, but look at it in multiple years, the non-banks are gaining share. And the more expensive you make it to manage a bank, that's going to accelerate that trend going forward. The other thing is the more expensive it is to run a bank, the more a bank's going to want scale to be able to afford those investments that they're going to want to consolidate. And it's a very predictable chain of events. And also, I had a chance to testify in front of Congress this quarter. One of the things that I said was there are unintended consequences from overreacting. Silicon Valley and these other banks failed because of liquidity. Okay, not because of capital. I think these higher ratios probably would not have stopped them from failing. And I think if Silicon Valley hadn't failed, maybe Signature and First Republic don't, because it was a contagion that expanded. I believe the first step should be deposit insurance reform, not increasing capital ratios. The FDIC actually laid it all out in a report, and they have a hybrid proposal that I think that's excellent. And I would say that should be the first step, not raising capital ratios, because that's going to have a whole dynamic on the bank, non-bank competition.